Welcome to another tutorial video. This one is going to be all about the financial metrics and ratios that you can use to analyze software as a service or SaaS companies, also known as subscription software companies. So as software has become one of the most highly valued sectors, we've been getting a lot more questions about the key metrics and modeling differences with companies in this industry. Also, as it happens, I'm currently working on two separate software as a service case studies, so this will be a quick preview of what's coming up in those full case studies. The most common questions here are about how to evaluate these companies, which metrics you should use besides simple growth rates and margins, and whether or not there are any new valuation multiples that you could use when valuing companies and comparing them to comparable public companies, precedent transactions, and so on. The short answer to this is that there are many new metrics, but there aren't really that many new multiples. There are technically a few valuation multiples such as free cash flow or unlevered free cash flow multiples that are maybe more applicable to SaaS companies than they are to normal tech companies or normal companies in general, but they're not really new. They still exist. They're just more applicable in this industry. The real answer is about the different metrics and ratios that you look at, which is why this tutorial is all about those metrics and ratios. For larger and public SaaS companies, you're often going to rely more on growth rates, operating or EBITDA margins, maybe even net margins if the company is mature enough. So you're going to be using more traditional metrics there. With startups and high growth private companies, since cash flow and fundraising are usually the key concerns, you want to use metrics that evaluate how efficiently a company wins customers and then how efficiently that company repays its sales and marketing expense after winning customers initially. So for example, if a company has to spend $100,000 to win a new enterprise customer, maybe it's a Fortune 500 company or a Fortune 100 company, and they're paying hundreds of thousands of dollars over the life of the contract, you want to be able to assess how much it actually earns from that customer if the customer stays with this company for 3 years or 5 years or 10 years. And that's the type of metric that you want to look at here. This specific metric is called the LTV to CAC ratio, or lifetime value divided by customer acquisition costs, and it means pretty much what it sounds like. You evaluate approximately how much the average customer is worth to the business, and then you divide by the initial amount that was spent to acquire this customer in the form of paid advertising, sales representatives, marketing staff, sales commissions, anything like that, travel expenses required to win the customer, anything like that goes in the denominator here for the customer acquisition costs. You also think about points like how long it takes the company to pay back these customer acquisition costs. Investors want to benchmark startups and see how much funding they actually need to fuel their growth. And if you think about the traditional efficiency metrics that we've covered in this channel before, like return on equity, return on invested capital, return on assets, these metrics, while they're useful for large, mature companies, they're often negative for startups, and they tend to be even more negative for software as a service startups and high growth companies. So they're pretty much useless. With larger and public SaaS companies, they will not necessarily disclose enough information to calculate these metrics. For example, sales and marketing for large public SaaS companies is rarely split out between new and renewal customers, so you have to make some estimates and make some approximations along the way. But these types of metrics, long story short, are much more useful for valuing private companies and startup companies that are just getting started ramping up and scaling than they are for valuing and evaluating large public companies. So we have a lot to cover in this lesson, and I'm going to give you a table of contents and the timestamps so you can skip around. First, I'm going to explain why the lifetime value calculation is tricky. Then we're going to calculate the customer acquisition costs for a sample startup company. And then in part 3, I'm going to talk about this LTV to CAC ratio and explain whether it is useful or deceptive or both. Then in part 4, we're going to explain an alternative called the CAC Payback period and explain why this might actually be more useful and why it's increasingly viewed as more useful than the LTV to CAC ratio. And then in part 5, we'll touch on a few other common SaaS metrics. Obviously, there's a lot of material here. We're not going to have time to go into all these points in depth. So I want to give you a high-level overview of what software as a service companies look like and how you typically evaluate them with a few of the most useful and common metrics. throughout this entire exercise, we're going to be using this Excel file, which you can download right below the video. And I have a lot of it filled out already for company A with 1-year contracts that are paid for upfront. We have some information about the annual contract value, the number of customers at the start of each quarter, and how many they win and lose in the quarter, how much their revenue changes in the quarter. So we have a lot of information. Same with the customer acquisition costs. A lot of that's already there. We also have something for company B, which is pretty much filled in already. We'll be using this as a comparison later on to illustrate a few key points. And then we also have an example for a large public company here, Confluent. So we'll be using their investor presentation and some of the metrics and stats that they disclose and seeing what a large public company looks like when we try to calculate these same types of SaaS metrics for them. Let's go into part 1 and talk about the lifetime value calculation. Now, the basic idea here is that you want to estimate how many years the average customer will stay with the business and then multiply by the average amount paid each year. Now, this sounds very simple, but there's a key problem, which is how do you estimate the average number of years with limited data? And what if the prices or the billing rates or the number of licenses or subscriptions or users for the subscription the company has changes over time? The most common formula here for estimating the average lifetime of a customer is you take the churn rate or the cancellation rate and then you put it in the denominator and you say 1 divided by the churn rate equals the average lifetime. For example, if the company has annual contracts and 20% of customers cancel each year, then you could say that the average customer stays for 5 years because 1 divided by 20% gives you 5. 1 over 20% equals 5. So the average customer lifetime here is 5 years. If we go to this Excel example for the company at the top, company A, we can say that we have the cancel rate here for customers who are actually up for renewal in the quarter. We can say 1 divided by the cancel rate, and that gives us the average number of contract cycles per customer. On average, you can see that according to this, we have customers who should be staying with the business for anywhere from 5 to as much as 10 years, because of course 1 divided by 10% is just 10. So according to this, in theory, these customers should be staying with us for quite a long time. But as usual, it's not quite that simple, and especially when you're dealing with high growth startups, you have to adjust these figures. The main issue here is that these lifetime estimates are often wildly off, and so they have to be discounted for younger startups. So you could do this in a couple different ways. You could scale down all the years by some fixed factor, or you could simply add the discount rate in the denominator. If you think about it, adding the discount rate in the denominator is really equivalent to increasing the cancellation rate. So if there is a 15% discount rate and the cancellation rate is 15%, if you add the discount rate, you're essentially just doubling the cancellation rate and you are reducing by 50% the average customer lifetime. So a better formula here, if you're working with this on an annual basis, is to say that the number of years equals 1 divided by the annual cancellation rate plus the discount rate, all in the denominator. And if you're working with contracts of different lengths, maybe there's 6 months or 2 years or 3 years, you're going to have to adjust all these figures based on this. But this is the basic idea for the most common annual contracts. So this company we're looking at is fairly early stage. If you look at the annual recurring revenue here, they only have about 4 to 5 to 6 million in revenue. So it's definitely in startup category. A company this small could not go public in the current environment at all. We have assigned a discount rate of about 20% because we assume that public companies in this sector probably have discount rates of about 10%. So a much smaller startup like this should probably have a discount rate that's at least twice as high as what large public companies in the sector have. If we go in and we make some adjustments here, let's now add that discount rate in the denominator. And now we can see that this comes way down, and it looks like the average customer here on a discounted basis is projected to stay with the company for more like about 3 years overall, which makes sense because this company is only a few years old. So how can we possibly say that the average customer is going to stay with us for 10 years if the company has only existed for 4 years or 5 years or even 6 years? Another issue here is with price increases. And generally speaking, if these are built into the contracts, so the contract always goes up by 3% per year, you could factor them in and you could use them to scale up the lifetime value. You could use something like the FV function in Excel. If you don't have any information about this, or if rates change on an irregular basis, then you can just use the current rate and not worry about price increases or changes. Once you get to the average amount paid per year times the expected customer lifetime in years, you might think you're finished, but there is actually still more to do. To illustrate, let's go down and take a look at this. Once we have the expected number of contract cycles per customer, we need to figure out, on average, how much each customer is paying to the company each year. So we're going to take the annualized recurring revenue, or annual recurring revenue, ARR here. Essentially, we're taking the monthly number and just multiplying it by 12. We want to take that and divide by the average number of customers in this period. So we have the average number of customers of 62 up there. And then for the average lifetime revenue contribution, if the average customer pays about $73,000 per year and they stay with us for 3.3 years, we just take that $73,000 and multiply by the 3.3, and we get to a lifetime revenue contribution of almost $250,000 right there. I have all the math up here above if you want to take a look at it. We don't think this company really changes the rates on a predictable recurring basis. It looks like they go up by roughly $2,000 or $3,000 per customer per year, but we have no information other than that. We don't know if these were one-time changes or if it happens like this every cycle, so we are not factoring that in for now. Of course, it's not quite this simple because even software companies have some type of gross margin because it costs something to support these customers. You have bandwidth costs, you have server costs, you have developer costs who are working with customers and supporting them and fixing bugs for them. So you have all these expenses that are directly attributable to specific customers signing up. Therefore, you should also multiply by the gross margin percentages because SaaS companies do have a cost of sales. So the LTV really represents the average gross profit per customer, not the average revenue. And actually, some people go further and they also deduct operating expenses that may be directly associated with new customers. We're not going to do that here, but you will see that sometimes, and it further reduces the LTV. So in this case, if we already have the gross margins from elsewhere in the model, we're going to take the average lifetime revenue contribution and multiply by the gross margin percentage. We can copy over all these numbers and then copy over this one as well. And so now we have the average customer lifetime value, the CLTV or LTV as it is usually abbreviated. For large public companies, they rarely disclose cancellation rates, but you can approximate lifetime based on industry averages. So for example, if you go down to Confluent here, I've taken the subscription revenue and the total number of customers directly from their 10K filings. They do disclose the number of customers if you go to my highlighted segment here. So they give us that information. And then if you go to the income statement, they also give us their subscription revenue. They give us their cost of revenue so we can get the gross margin like that. But they don't really have much else there. They don't have anything about the cancellation rate. So one approach here is to say that on average for enterprise-focused software companies, companies that sell to other large businesses, the average customer stays for about 4 or 5 years if you have 1-year contracts. So I've used 4.5 here. And by doing this and by taking the annual subscription revenue and dividing by the number of customers, we can get to an average annual contract value. By taking this 4.5 number and multiplying, we can get to the average lifetime revenue contribution from each customer. And then we can just multiply by the gross margin to get to the average customer lifetime value. So this is how you could approximate it for a large public company like this one. That's lifetime value. Let's go now to the next part and talk about customer acquisition costs. The main question here is which expenses do you include, and does the company actually disclose enough information for you to separate these out and include them in your analysis? So you definitely want to include marketing salaries and benefits, paid advertising, commissions paid to sales reps on new customer sales, and any executive time and money that is spent to win new customers. If you look at our columns here, I'm taking all these numbers from elsewhere in a much more complex model, but you can see these types of categories: marketing, salaries and benefits, lead generation, in other words, paid advertising campaigns, sales, salaries and benefits, cash commissions on new sales, executive time. All these are pretty standard. With sales, salaries, and benefits, technically you should try to split it between new and renewal sales reps. And then you have other expenses like overhead, onboarding, and it's not clear if they should be included or not. We are including them here, but if you couldn't separate them out and assign some to new customers versus renewal customers, I probably wouldn't bother with this. Large public companies, again, rarely disclose costs for new versus renewal customers, but you could make rough estimates. Some people say that maybe around 2/3 to 3/4 of total sales and marketing for SaaS companies is usually spent to win new customers. Again, just kind of an industry standard metric there, although it does vary a lot by vertical and company type. So, for example, for Confluent, I've taken their sales and marketing from their 10K filing here on the income statement. I've just pulled in all these numbers. And then I've said that 2/3 is dedicated to winning new customers. And so by multiplying the 2/3 by these numbers, I can get to the estimated customer acquisition costs. And then I can take the new customers in the period and just take the CAC, divide by the new customers, and get to the average customer acquisition costs like that. Once you have these average customer acquisition costs, you can take the lifetime value and then you can divide by the customer acquisition costs and get to the LTV to CAC ratio, which is a very rough estimate down here, but we actually get pretty reasonable numbers of between 2x and 4x, which you often do see in this industry. Now, if you go up and you look at this number for company A here as I label them, if we take the customer acquisition costs and we divide by the new customers in the period. So let's go up and get that new customers right there. And then we'll get the average customer lifetime value, divide by the CAC. We got our ratio right here, which jumps around a lot, but again, it's actually in about the same range as Confluent's ratio, which is around 2x to 5x here. So they go slightly higher, but in most of this period, we could say that they're roughly between 2x and 4x in terms of LTV to CAC. Now, is this ratio actually useful or is it deceptive? And I would say it's a bit of both. If you calculate it and adjust it properly, it can be useful, but like all financial metrics, it's not gravity, it's not relativity, it's not a law of nature, it's just a rough guideline. I think the biggest problem with this metric is that startups have a very limited data set. If a company only has 10 or 20 customers and it's only been around for a few years, you can't really say what the lifetime value is going to be because the company just hasn't been around for all that long. So you need to make some type of risk adjustment to this metric. If a startup has only existed for 3 years, you can't really say that the average customer is going to stay with them for 5 years just because so far, over the past 3 years, they've had a 20% annual cancellation rate. You actually need to look at more data and see over 10 years or 15 years, how long does the average customer actually stay with them? I think it's also dangerous to make LTV to CAC a driver in a model. You really want to focus on leads and conversions and sales reps and how efficiently they're operating and renewals and pricing and other things like that that you can use as easy inputs. The best use is for you to look at this and be able to tell if one startup or another high growth company is operating more efficiently or less efficiently than another one. It also lets you tell things like if company A wants to reach a certain amount in cumulative revenue, how much is it going to have to spend on sales and marketing to get there? Large public companies tend not to disclose LTV or CAC. They will instead tend to focus on metrics like gross retention and net retention, which are really variations on the renewal rate of the company, which we'll get into in a little bit. So the bottom line is that LTV to CAC has its uses, but you can't interpret it too literally. There seems to be this rule online that an LTV to CAC of 3x or above is good, and if you're below that, then you're not doing well. But I wouldn't take that too literally because there's so much variation in the way that companies calculate LTV, and there's even some variability with the customer acquisition costs. Just to illustrate how much of a difference these types of discounts and adjustments can make, if we look at this company, company A, and let's say that we remove the discount rate altogether, we set it to 0%. Now the LTV to CAC here goes up to a very high level, 8x, 9x, even 15x in some periods. If we go to company B, which is a much larger, more mature company, annualized recurring revenue of 50 million, 60 million, 70 million, a company like this could definitely go public. If we remove it here, the LTV to CAC seems a lot lower on the surface. It's only 6x, 7x, 8x, something in that range. But if I go back in and apply the proper discount rates, a much higher discount rate for company A, and then a much lower discount rate for company B, the LTV to CAC for these companies is actually in about the same range. It's around 3x to 4x for both companies. So if you properly adjust this metric for risk and potential returns of the startup or other high growth company, it can work pretty well. But of course, most people never even make this adjustment or think about the possible problems with trying to estimate this based on very limited data. That's LTV to CAC. Let's now look at a possibly better alternative called the CAC Payback period. The idea here is that if a company spends $100,000 to acquire an average customer, how many months will it take to recoup the cost? That's what the CAC Payback period tells you. One way to calculate this is to look at the monthly CAC and divide it by the net new monthly recurring revenue. The net new monthly recurring revenue is the additional monthly subscription revenue from new customers in the period that you're looking at, minus the lost monthly subscription revenue from canceling customers in that same period, and then you multiply by the gross margin percentage. You have to be careful here with converting between different time periods like months, quarters, and years. Let's take a quick look at this and see how it works. So I'll go up to company A here, and for the new monthly recurring revenue, let's go up and take our new customer revenue right here, and then the lost recurring revenue down here. So we're adding both these together. Now, this is the quarterly figure for both of these. So to convert this into months or get this on a monthly basis, we need to take the new customer additions, subtract the lost recurring revenue, and then divide by the number of months in a quarter, 3 right here. So we have that. And then we can multiply this by the gross margin percentage because, again, we have a certain amount of costs required to support these new customers. And then for the CAC payback period, we want to take the customer acquisition costs here, which again is on a quarterly basis. So we want to divide this by the months in the quarter, 3. And then we'll divide this by the net new monthly recurring revenue. And that gives us our payback period. Let's copy and paste all these over. And so we can see that on average, it takes probably between 3 and 7 months for this company to pay back its sales and marketing required to win new customers. If we take an average, it comes out to about 6 months here. If we go down to this other company, it actually comes out to a higher number. So even though the LTV to CAC numbers are quite similar, this company clearly takes a few more months to actually recoup its sales and marketing costs. And this is one of the reasons why the CAC payback period metric can be so useful. It can tell you a different story than the LTV to CAC, even though both are based on similar ideas. The advantage of the CAC payback period metric is that it's much shorter term. You don't need any information about the average customer lifetime. You don't need the discount rate, the price increases. You don't need anything about upsells or expansions or anything like that. Shorter is better with this metric. Often companies aim for less than 12 months, but if it's longer than that, it can be fine. If a company is selling 5-year contracts and it takes 2 years to recover the costs, it doesn't really matter that much because if you think about it, it's not much different from a company with 12-month or year-long contracts that takes, say, 4 or 5 months to recoup its costs. The CAC payback period is arguably more useful for figuring out companies' funding requirements as well. If it takes a company 1 year to recoup sales and marketing costs, and it takes another company 2 years, the company on the 2-year time frame is probably going to have to raise funds more quickly than the company on a 1-year time frame. So that's a little bit about the CAC payback period. I didn't mention it, but for public companies, it's almost impossible to calculate this because they're not going to break out new customer revenue versus revenue from renewal and upsell customers. And they're not going to show you all the components separately. So it is very, very difficult to calculate this for large public companies. I want to wrap up by going over a few other common SaaS metrics here. We don't have a lot of time to delve into these, but I do want to at least mention them and highlight a few things quickly. One set of common metrics is billings, bookings, and revenue. And this is really a whole separate topic that could be the subject of a whole series, but these are about total contract value, bookings, the amounts invoiced to the customer, which is billings, and then the amount from the products and services delivered in a specific period, which is revenue. So here's a very simple way to understand it. Let's say that there's a company with 1-year contracts. If it's a contract for $120 per year, billed once at the start of each year, the bookings and billings and revenue for year 1 will all be $120, and the monthly revenue will be $10 each month times 12 months equals $120 for the year. Now, if this company switches to 2-year contracts, then the bookings when the contract is initially signed would be $240 because that's the total contract value over those 2 years, 2 times $120. The annual billings and revenue here are $120 each year, and you have that for 2 years. And then the monthly revenue is $10. $10 over 12 months is $120. And then if you extend it over 24 months, that's $240. So that's the basic difference between all these. Some large and public SaaS companies also like to focus on gross retention and net retention numbers. If we look at Confluent and you go to their investor presentation, they don't tell us anything about the cancellation rate or the expected lifetime of customers or the lifetime value of customers, but they do give us this dollar-based net retention rate. The numbers here of 125% and 130% look quite good, but the issue here is that gross retention is the percentage of recurring revenue retained when you ignore upgrades, upsells, expansions, price increases. So it's essentially the revenue from existing customers at the end of one period divided by the revenue from those same customers at the start of the period. And it's strictly based on the cancellation rate or the churn rate versus the initial revenue. Net retention is the percentage of recurring revenue retained when you include upgrades and upsells and expansions and price increases and the cancellations as well. In our opinion, gross retention is more useful because it's closer to reality, it's more conservative, and it really only depends on the cancellation rate or the churn rate, not everything else that goes into it. But a lot of companies like to disclose or focus only on net retention, especially when it's over 100%. But you have to be really careful because you don't know exactly what goes into it. They never give you the components. So if the company enacted a 20% price increase and they say that their net retention is 110%, that should make you skeptical because it means their cancellation rate is at least 10% and it might actually be more than 10%. So be very careful with these types of metrics. They're useful, but we think gross retention is actually a lot more useful than net retention simply because of all these different components and how they tell you different things. That's about it. So let's do a quick recap and summary. The lifetime value calculation is tricky because no one agrees on exactly how to calculate how long a customer will stay with the business. Startups often have very limited operating history, so it's hard to say much here, and you have to properly discount this if you are calculating it for a startup or other high-growth private company with limited operating history. Calculating the customer acquisition costs is fairly simple if you have detailed information from the company, as we did in some of these examples. If you do not have that, then you're going to have to make very rough estimates based on their public financial statements. The LTV to CAC metric is useful if you discount it and adjust it properly. If not, then it can be highly deceptive. We think a better alternative is generally the CAC payback period because it's short term. It's usually based on events that happen in a year or 2 years or less, as opposed to going out 5 years or 10 years and assuming that customers will still be around then. You saw how even when the LTV to CAC ratio for these two companies tells you one story, if you look at the CAC payback period, it could tell you quite a different story, and it's all because of how the adjustments are different and how the LTV calculation itself is much more subjective than something like the amount of net new monthly recurring revenue that is added in one specific period. And then we talked about a couple other SaaS metrics that are common, like bookings, billings, revenue, and then the gross retention and net retention. This video obviously isn't comprehensive, but I wanted to introduce this topic and give you something to work with and some idea of what these metrics mean and how you can use them to analyze and evaluate software as a service companies.